Okay, let's kind of pivot the conversation here. Obviously, we're talking about income generation, moving over to that value side of things. The JEPI ETF,
Yes.
JEPI. What's the case for this ETF? Why do people love it so much? And is now the right time for this ETF to be in a portfolio?
Yeah, I mean, for the record, for everyone listening, I cannot buy JEPI because I'm not a US citizen and I cannot buy non-UCITS ETFs. But I always liked the strategy, and many people did because it's right now it has a yield of 7%. And now dividend investors, generally speaking, like income. Um, but JEPI, and I brought a chart with me. I brought the ratio between JEPI and S&P 500. Do the same with value and growth. A declining chart means the S&P 500 is outperforming, and an increasing chart means JEPI is outperforming. And if the stock price increases, you still have the premium. You get a premium when you sell a covered call, but you don't have the underlying stock anymore. So that's a headwind. Um, but in a scenario where stocks remain flat or even go down, then the chances of your stocks being called away fall. So when we look at this chart of this comparison between JEPI and S&P 500, we see that in 2022, JEPI outperformed the S&P 500 for more than a year. And the same is happening right now. Since the start of this year, JEPI is outperforming, that's because investors in JEPI get to keep the premium. They always do, because once you sell covered call, you have the premium, and they also keep their shares. Even though the share prices decline as well, you still have the benefit compared to the market because your shares don't get called away and you have the premium. So you have improved income in general. It makes more sense to focus on income and sell covered calls, which makes JEPI, to me, more interesting than the S&P 500 for dividend investors going forward. And I brought a chart with me which shows the S&P 500 PE ratios compared to the subsequent 10-year returns and 1-year return. And what we can see on a short-term basis is basically a random walk. Over the next 12 months, it doesn't matter if the S&P 500 is cheap, cheap in quotation marks, or expensive. It's basically a random walk. But on a longer-term basis, the higher the valuation, the lower the expected return. And at current levels, we are basically dealing with an expected annual return between 0 and 4 to 5%, which isn't the end of the world, but it's very unfavorable compared to what people have been used to over the past 15 years. And in this environment, I think it makes sense to generate additional income from selling covered calls.
Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank.